My dear students, welcome back to our channel. Students, in this video I am explaining MBA third semester. Subject Banking and Insurance, first unit. Important short and long questions and answers. Let's start quick revision. First important short question is Scheduled Commercial Banks. Scheduled commercial banks are financial institutions listed in the second Schedule of the Reserve Bank of India, RBI, Act 1934. They comply with the required statutory criteria set by the RBI, such as maintaining a minimum paid up capital and reserves. These banks are eligible for membership in the clearing house, can participate in the RBI's lending programs, and benefit from other facilities. Examples of scheduled commercial banks include State Bank of India, SBI, HDFC Bank, and ICICI Bank. These banks play a crucial role in the economic development by providing loans, accepting deposits, and facilitating payments. Next important short question is Foreign banks. Foreign banks are banks that are incorporated outside the country but operate branches or subsidiaries within that country. In India, these banks are regulated by the Reserve Bank of India, RBI, and are subject to local banking laws. Foreign banks often bring global banking expertise and offer specialized services to international businesses. Examples of foreign banks in India include Citibank, Standard Chartered, and HSBC. These banks typically cater to multinational corporations, high net worth individuals, and provide foreign exchange services, along with other financial products. First important long question is Describe the structure of Indian banking system. The Indian banking system is a complex network of institutions that facilitates financial services, promotes economic development, and supports monetary stability. It is broadly classified into various types of banks based on ownership and function. Here's a breakdown of its structure. 1. Reserve Bank of India, RBI. At the core of India's banking system is the Reserve Bank of India, RBI, the central bank responsible for regulating and overseeing the banking sector. The RBI formulates monetary policies, issues currency, manages foreign exchange reserves, and acts as the banker to the government and other commercial banks. 2. Commercial banks. Commercial banks play a vital role in accepting deposits and providing loans for businesses and individuals. They are further categorized into public sector banks, PSBs. These banks are majority owned by the government. They include large institutions like the State Bank of India, SBI, Punjab National Bank, PNB, and Bank of Baroda. Private sector banks, owned by private entities, these banks focus on providing modern banking services. Examples include HDFC Bank, ICICI Bank, and Axis Bank. Foreign banks, these are banks established outside India but operate within the country. Examples are Citibank, Standard Chartered, and HSBC. 3. Cooperative banks. Cooperative banks cater to the needs of rural and semi-urban areas, particularly in agriculture and small-scale industries. They operate on a cooperative basis, with a focus on financial inclusion. Key institutions include urban cooperative banks and rural cooperative banks. 4. Regional rural banks, RRBs. RRBs are specialized institutions established to provide banking services to rural areas, especially focusing on the agricultural sector. They are sponsored by public sector banks and aim to promote financial inclusion. An example is the Prathama Bank. 5. Non-banking financial companies, NBFCs. NBFCs are financial institutions that provide banking services without holding a banking license. They focus on offering loans, asset management, and insurance services. Examples include Bajaj Finance and HDFC Ltd. This multi-tiered structure ensures that India's banking system serves diverse sectors, including rural and urban areas, businesses, and individuals, contributing to overall economic development. Next important long question is commercial banks versus payment banks. Commercial banks and payment banks are two distinct types of financial institutions in India, each serving different roles within the banking system. Commercial banks. Commercial banks are the backbone of the Indian financial system, offering a wide array of services to individuals, businesses, and government entities. These banks engage in accepting deposits, granting loans, facilitating fund transfers, and offering financial products such as credit cards, mortgages, and wealth management services. They have the flexibility to cater to a broad range of customers, from individual account holders to large corporations. Key features: deposit services, accept savings, current and fixed deposits. Loans and credit, provide loans to individuals, businesses, and industries. Wide service range, offer credit cards, overdraft facilities, and foreign exchange services. Full-scale operations, can operate in both urban and rural areas with nationwide and international branches. Example: State Bank of India, SBI, HDFC Bank, ICICI Bank. Payment banks. Payment banks, introduced by the Reserve Bank of India, RBI, in 2014, are a new category of banks aimed at promoting financial inclusion, especially in underserved and rural areas. These banks offer limited services and primarily focus on providing a platform for basic banking needs like deposits, money transfers, and electronic payments. They are designed to cater to customers who have limited access to traditional banking facilities. Key features: deposit limits, accept deposits up to 2 lakh rupees per individual. Limited services, provide money transfers, mobile wallets, and payment services but do not offer loans, credit cards, or overdrafts. Digital focus, encourage cashless transactions and electronic payments. Financial inclusion, primarily aimed at serving unbanked populations through mobile banking and remittance services. Example: Paytm Payments Bank, Airtel Payments Bank, India Post Payments Bank, IPPB. Key differences: services. Commercial banks provide a full range of banking services, including loans and credit facilities, while payment banks focus on deposit acceptance and electronic transactions. Loan capability: commercial banks can offer loans, whereas payment banks cannot. Deposit limits: payment banks have a cap on deposits, 2 lakh rupees, unlike commercial banks that can accept larger deposits. In conclusion, while commercial banks offer comprehensive banking solutions, payment banks are more specialized, focusing on financial inclusion and digital transactions. Next important long question is types of banking. The banking system can be categorized into various types based on the services they offer, the clientele they serve, and their operational structures. Below are the main types of banking in India. 1. Commercial banking. Commercial banks are the most common type of banks that offer a wide range of financial services to individuals, businesses, and government entities. They accept deposits, provide loans, facilitate money transfers, and offer investment products. Commercial banks include public sector banks, PSBs. These are owned and operated by the government, such as the State Bank of India, SBI, and Punjab National Bank, PNB. Private sector banks. These are owned by private entities such as HDFC Bank and ICICI Bank. Foreign banks, international banks operating in India like Citibank and HSBC. 2. Cooperative banking. Cooperative banks are organized on a cooperative basis, serving primarily rural and agricultural sectors. They are focused on providing credit and banking services to farmers, small businesses, and rural populations. These banks are governed by the principles of cooperation and mutual help. They include urban cooperative banks and rural cooperative banks with the aim of promoting financial inclusion in underserved areas. 3. Development banks. Development banks are specialized financial institutions that provide long-term credit for industrial and infrastructure development. These banks focus on promoting economic growth by financing large-scale projects in sectors like agriculture, industry, and infrastructure. The Industrial Development Bank of India, IDBI, is an example of a development bank. 4. Regional Rural Banks, RRBs. RRBs were established to provide banking services in rural areas. Their focus is on agricultural development and providing credit to farmers, small entrepreneurs, and rural households. These banks are sponsored by commercial banks and work towards enhancing rural economic development. Prathama Bank is an example. 5. Payment banks. Payment banks are a new category of banks that offer basic banking services, such as deposits, money transfers, and electronic payments. They are designed to serve the unbanked and underbanked populations with a focus on digital banking. Payment banks cannot offer loans or credit cards. Examples include Paytm Payments Bank and Airtel Payments Bank. Conclusion. Each type of bank in India plays a distinct role, from commercial banks offering broad services to payment banks focused on financial inclusion, supporting the country's diverse economic needs. Next important long question is evolution of banking in India. The evolution of banking in India has been a dynamic journey marked by significant milestones in response to the country's economic needs and development. The history of banking in India dates back to ancient times but took a more structured form with British colonial influence and continued to develop post-independence. 1. Ancient and medieval period. In ancient India, banking was informal, based on practices like grain banks and money lending. Early references to banking activities are found in texts like the Arthashastra, which mentions methods of lending and borrowing. During the medieval period, money lenders played a key role in facilitating financial transactions in local markets. 2. Colonial era, 1770s, 1947. Modern banking began during the British colonial period with the establishment of the first formal bank, the Bank of Calcutta, later renamed the Bank of Bengal, in 1806. Following this, the Bank of Bombay and the Bank of Madras were set up, collectively forming the Imperial Bank of India in 1921. The establishment of these institutions marked the beginning of organized banking in India, largely to serve colonial trade and business needs. 3. Post-independence era, 1947 to 1969. After India gained independence in 1947, the government focused on promoting financial inclusion and providing banking services to underserved sectors. The first significant step was the nationalization of the Reserve Bank of India (RBI) in 1949, making it the central bank. In 1969, the Indian government nationalized 14 major commercial banks, aiming to ensure that banking services reached rural areas and supported the growth of agriculture and industry. 4. Reforms and liberalization, 1991 onwards. The early 1990s marked a turning point in the evolution of Indian banking with the liberalization of the economy. The introduction of reforms in 1991 encouraged competition, privatization, and technological advancements. The establishment of private sector banks like HDFC and ICICI Bank led to an expansion of services and the introduction of modern banking practices. 5. Digital banking era, 2000s present. In the 21st century, the rise of digital banking has reshaped the Indian banking sector. The introduction of mobile banking, internet banking, and the National Payments Corporation of India (NPCI) brought banking to the fingertips of millions. Initiatives like Jan Dhan Yojana and the promotion of UPI Unified Payments Interface have further promoted financial inclusion and digital payment systems. Conclusion. From its ancient roots to the modern digital banking era, the evolution of banking in India reflects the country's changing economic landscape. Today, India's banking system is one of the largest in the world, characterized by a diverse range of financial services, technological innovation, and a focus on inclusive growth. Next important long question is: role of commercial banking and economic development. Commercial banks play a pivotal role in the economic development of a country by facilitating financial services that are crucial for the functioning of the economy. Their operations directly impact various sectors, including businesses, individuals, agriculture, and infrastructure development. 1. Facilitating credit and investment. One of the most important roles of commercial banks is providing credit to individuals, businesses, and industries. By offering loans for capital investment, working capital needs, and personal consumption, commercial banks stimulate economic activities. Loans to industries and businesses help expand production capacities, increase employment, and enhance overall productivity, thus contributing to the country's GDP growth. 2. Promoting savings and investments. Commercial banks encourage savings by offering a variety of deposit products, including savings accounts, fixed deposits, and recurring deposits. By pooling savings from individuals and businesses, they create a source of funds that can be used for productive investments. This, in turn, boosts capital formation and provides the necessary funds for long-term infrastructure projects and industrial growth. 3. Financial inclusion. Commercial banks are crucial in promoting financial inclusion by extending banking services to underserved and rural populations. With government initiatives like Jan Dhan Yojana and the expansion of mobile banking services, commercial banks have been able to provide access to financial services to millions of people, enabling them to save, invest, and avail loans. This helps reduce poverty and boosts the purchasing power of low-income households. 4. Supporting government initiatives. Commercial banks also play an important role in implementing government policies and initiatives aimed at economic development. They are involved in distributing loans under government schemes for agriculture, rural development, and small businesses. Furthermore, they support government fiscal policies by managing public funds, government securities, and facilitating taxation and payment systems. 5. Improving infrastructure and employment. By financing large-scale infrastructure projects such as roads, bridges, and airports, commercial banks contribute to the development of essential infrastructure. This, in turn, helps create jobs, enhances connectivity, and stimulates further economic activity. Conclusion. Commercial banks are vital to the economic development of a country. Their ability to provide credit, encourage savings, promote financial inclusion, and support government initiatives helps create a robust economy, fostering growth, employment, and improved living standards. Next important long question is: sources of risk in banks. Banks face various sources of risk that can impact their operations and financial stability. These risks arise from both internal and external factors and require effective risk management practices to mitigate potential losses. Here are the primary sources of risk in banks. 1. Credit risk. Credit risk arises when borrowers fail to repay loans or meet other credit obligations. This is one of the most significant risks for banks since it directly impacts their profitability. Poor credit assessment or economic downturns can lead to defaults, affecting the bank's financial health. For example, if a business defaults on a loan, the bank may incur losses. 2. Market risk. Market risk refers to the risk of losses due to fluctuations in market variables, such as interest rates, stock prices, or foreign exchange rates. Banks are exposed to market risk when they hold financial instruments like bonds or equities, or engage in foreign exchange trading. A change in interest rates or a volatile stock market can lead to substantial losses for banks. 3. Liquidity risk. Liquidity risk arises when a bank is unable to meet its short-term financial obligations due to a lack of liquid assets. This situation can occur if a large number of depositors withdraw funds simultaneously, a bank run, or if there is a sudden demand for cash. Effective liquidity management is crucial for ensuring that a bank can continue its operations smoothly. 4. Operational risk. Operational risk stems from internal processes, systems, or human errors. This can include fraud, technological failures, or ineffective internal controls. For example, a cyber attack could disrupt banking operations, leading to financial losses or reputational damage. It also includes risks from outsourcing, employee mistakes, or operational inefficiencies. 5. Legal and compliance risk. Banks are subject to a range of laws and regulations, and failure to comply with them can result in legal penalties, fines, or reputational damage. Compliance. Risk arises when banks fail to adhere to regulatory requirements or face lawsuits for non-compliance with laws. 6. Systemic risk. Systemic risk arises when a bank's failure or the failure of multiple financial institutions causes a broader collapse in the financial system. This risk is often linked to the interconnectedness of financial institutions, where the failure of one can lead to a chain reaction affecting the entire economy. Conclusion. The sources of risk in banks are diverse, ranging from credit and market risks to operational and compliance risks. Effective risk management, including proper assessment, monitoring, and mitigation strategies, is crucial for maintaining the stability and profitability of banks and safeguarding the broader financial system. Next important long question is analyzing banks' financial statements. Analyzing a bank's financial statements is essential for understanding its financial health, performance, and risk exposure. This analysis helps stakeholders like investors, regulators, and management make informed decisions. The key financial statements to consider are the balance sheet, income statement, and cash flow statement. 1. Balance sheet. The balance sheet provides a snapshot of a bank's financial position at a specific point in time. It lists assets, liabilities, and equity. Assets include loans, cash reserves, investments, and physical assets. The quality of assets, example, the proportion of non-performing loans, is critical in assessing the bank's credit risk. Liabilities primarily consist of customer deposits, borrowings, and other obligations. A higher proportion of low-cost deposits is favorable for a bank's profitability. Equity represents the capital invested by shareholders and retained earnings. A strong equity base indicates financial stability and the ability to absorb losses. 2. Income statement, profit and loss statement. The income statement reflects a bank's profitability over a specific period, usually quarterly or annually. It shows net interest income, NII, the difference between interest earned on loans and paid on deposits. A high NII indicates a profitable core lending operation. Non-interest income includes fees, commissions, and trading profits. A diversified income base reduces dependence on interest income and enhances stability. Operating expenses, these include staff costs, administrative expenses, and provisions for loan losses. Efficiency ratios, like cost-to-income ratio, help assess how well the bank controls expenses. Net profit, the bottom line, shows the bank's overall profitability after all expenses and taxes. 3. Cash flow statement. The cash flow statement highlights the liquidity position of a bank, focusing on operating cash flows, cash generated from core banking activities. Example, loan repayments, deposit withdrawals. Investing and financing cash flows shows cash used in purchasing or selling assets and in raising capital or repaying debt. Key ratios. Key financial ratios help in assessing a bank's performance. Return on assets, ROA, and return on equity, ROE, indicate profitability. Capital adequacy ratio, CAR, measures the bank's ability to absorb losses. Loan-to-deposit ratio helps assess liquidity risk. Conclusion. Analyzing a bank's financial statements provides valuable insights into its risk management, profitability, liquidity, and overall financial strength. Key ratios and trends within these statements guide stakeholders in assessing the bank's ability to navigate economic challenges and continue growing. Students, for other units explanation and other subjects quick revision or explanation links are available in description. Check out once. I think it will be useful to you. Thank you. Thank you for watching. Like and share this video with your friends.